What should investors make of President Trump backing new Fed Chair Kevin Warsh? The headline is simple. Rates likely stay put this week, but the playbook beneath the surface could change. Markets are primed for no move on the policy rate. The surprise is not the decision. It's the direction of strategy, communication, and regulation that could steer pricing across stocks, bonds, and even crypto-adjacent narratives over the next year. Clear support from the White House reduces the usual credibility gap for a new chair. That gives Warsh a window to focus less on signaling each meeting and more on how the Fed's tools actually work. Expect the near-term setup to be steady. Mixed economic data argues for patience. Attention shifts to the statement, the projections, and the press conference language. That is where forward guidance lives and where markets reprice duration, credit, and equity risk premia. The longer game is about structure. Warsh can refine the policy framework and how the Fed talks about it. He can reassess the pace of balance sheet runoff, which affects term premiums and mortgage spreads even when the policy rate does not move. He can review liquidity facilities and standing backstops that determine how stress transmits through funding markets. Small design changes here can matter more for ETFs, money markets, and bank funding costs than a single hike or cut. Supervision may also shift, recalibrating capital and liquidity expectations, updating payment system plumbing, and clarifying the guardrails for new financial rails can shape credit availability and risk appetite. That matters for lenders, brokers, and fintechs, and it feeds back into valuations. Keep the anchor in sight. The 2% inflation goal still frames the path for real rates and discount rates. With 8 scheduled FOMC meetings a year, the milestones are clear, and guidance between meetings carries weight. The Fed's decentralized structure brings regional data to the table, which can tilt the conversation if housing, manufacturing, or services slow unevenly. For portfolios, the practical takeaway is to listen beyond the rate. Watch the balance sheet language, the description of inflation persistence, and any hints on liquidity tools and supervision. Stress test duration and credit exposures for a world where term premiums can move without a policy rate change. And expect communication tweaks to drive sector rotation and ETF flows around meeting dates. Want the full breakdown and what to monitor next? Read the full article at finlitica.com.